Your credit card sits quietly in your wallet. Most of the time, it looks harmless. Just a small piece of plastic. It's a normal day. You walk into a store, you pick something up. You walk to the register, you pull out your credit card, and you swipe. The machine beeps, the payment is approved. You grab your receipt, and you leave. To most people, that's the end of the story. You paid, the store got their money, transaction complete. But that's not actually what happened. Because the moment you swiped that card, an entire financial system started moving behind the scenes. And the truth is, most people completely misunderstand what just happened. Every time you swipe your credit card, the bank secretly hopes you don't pay it back. Here's what actually happens. Let's go back to the moment you swipe your card. The terminal sends a request. This request travels through the payment network. Companies like Visa or MasterCard process this information. They check with the bank that issued your credit card. The bank looks at your account. It checks three things. First, is the card valid? Second, is the transaction suspicious? Third, do you have enough available credit? If everything checks out, the bank approves the transaction. All of this happens in just a few seconds. But here's the important part. You did not just pay the store. In fact, you didn't pay anything at all. Your bank did. The bank immediately pays the merchant on your behalf. The store receives the money. The transaction is completed, and you walk out with your purchase. But now something else exists, a debt. You now owe the bank the money it just paid for you. In other words, a credit card is not really a payment tool. It's a short-term loan machine. Every swipe creates a tiny loan. Some loans are small, a coffee, a sandwich. Some are larger, a laptop, a vacation. But they all work the same way. The bank pays first. You pay later. At the end of the month, the bank sends you a statement, a list of everything you bought, every swipe, every transaction, every loan. If you pay the full amount before the due date, something interesting happens. You pay zero interest. From the outside, it looks like the bank made no money. But that's not entirely true, because the bank already took a small cut. Every time you swipe your card, the merchant pays a fee, usually around 2 to 3% of the purchase. This is called the interchange fee. Part of that fee goes to the payment network. Part goes to the bank that issued your card. So even if you pay your balance in full, the bank still earns something. But this is not where the real money is. The real money appears when you don't pay the full balance. Because if you don't, the interest machine starts. Let's say you spent $1,000 on your credit card. At the end of the month, you only pay $200. That means $800 remains unpaid. From that moment on, the bank starts charging interest on that balance. And credit card interest rates are not small. They are often between 20% and 30% per year, sometimes even higher. This is where things begin to snowball, because the interest gets added to the balance. Then next month, interest is calculated again, not just on what you bought, but on the growing balance itself. This is called compound interest, and it can quietly turn a small purchase into a very expensive one. A $1,000 balance can become $1,200, then $1,500, then even more, all while you continue making minimum payments, which leads to an uncomfortable truth. The credit card system works best when customers stay in debt, because someone who pays the full balance every month generates relatively little profit, but someone who carries a balance for months or years becomes extremely profitable. In fact, banks design credit cards with this behavior in mind. Minimum payments are intentionally small, often just 2 to 3% of the balance, low enough that almost anyone can afford them, but low enough that the debt barely shrinks, which means interest keeps accumulating, month after month, year after year, and many people don't even realize it's happening. Because the system feels painless. You swipe, you leave, you pay a small amount later. It feels manageable, almost harmless. But behind the scenes, the interest meter keeps running, and the bank keeps earning. Of course, credit cards are not inherently bad. They can be incredibly useful. They provide convenience, fraud protection, rewards, cashback, travel points, and short-term flexibility, but only if they are used carefully, because the system has one quiet assumption built into it. The bank expects some customers to slip, some customers to delay, some customers to carry balances, and those customers generate the majority of the profit. Which brings us back to the moment you swipe your card. The store gets paid instantly. You walk away with your purchase. And for a brief moment, everything feels finished. But from the bank's perspective, the transaction is only just beginning, because every swipe starts a timer that ends when you pay the balance in full, or when the interest machine begins to run. And every time you swipe your credit card, the bank secretly hopes you take just a little bit longer to pay it back.